In today's video, we'll be looking at the top 5 beginner investing mistakes. This is the video that I wish I saw when I first started investing, and it would have saved me a ton of time and money. Investing can seem quite overwhelming with a lot of choices to make, from which companies should you invest with, what brokerage platform is the best, and ultimately what is the most beneficial strategy to maximize your returns in the stock market. After watching this video, you'll have a much better idea of how to invest and some practical steps that you can take to make sure that you get the most out of your stock market investments. If you find the video helpful, make sure to drop a like for the YouTube algorithm and subscribe to the channel so you can stay updated with future content. My first tip is starting early. You don't have to wait until you have a lot of money in the bank to start investing. Even just beginning with $10 is better than nothing. It's more important that you start instead of waiting until you have a big lump sum of money to invest. The thought of putting your money into a place where you can't control it and it can go through changes both going up and down in value can seem a bit counterintuitive. The whole process can feel risky and even stressful, but the more you do it, the more comfortable you become, and that's why it's important to just start with some money, just to get a feel for it, get an idea of what it's like to put your money into a place like the stock market and seeing it go through these changes that you're not quite in control of. The more you do it, the easier it is to place more money into the market and you break through that mental barrier. If you wait until you're trying to have the lump sum of say $1,000 plus to invest, this can just be too much of a block or too much friction and stop you from actually starting, because you don't need a lot of money to begin. You just have to begin and then gradually build that process, build your knowledge, put some time and effort into understanding the market, research some companies, read some books about investing, and then over time you'll build your skill set and ultimately become better at making investments and make more money for yourself. It's really beneficial for you because it motivates you to hold on to your money. Instead of thinking of what you can buy, you think about how much you could invest in the market, how much money you could make, and then you will use your money more productively as opposed to just spending it on material items. This is something that I definitely noticed for myself. Investing has really improved my spending habits, and I think it's something great for everyone to get involved with. Obviously, some people will take to it more than others, but at least trying it out is better than not trying it at all. Number 2 is don't try and time the market. Perfectly timing buying and selling points, spending hours looking over stock graphs can be a very challenging and also stressful task. Accurately picking the exact time to buy or sell a company is no easy feat, and doing it routinely, having it as your only stock market investing strategy, can make things a lot harder than they need to be. There's a saying that goes, spending time in the market is better than timing the market, meaning that the more time you spend invested, the better your rewards will be. If you keep waiting on when you should buy in or when you should begin your investing journey, you're ultimately just going to be sitting on the sidelines, wasting time and missing opportunities that you could have taken up if you had just started earlier. The longer you invested, the more your money can grow and compound over time. Picking something nice and diversified like an ETF that tracks the overall stock market performance is always a great place to start, because it doesn't require any background knowledge or research. It's something tried and true that you can hold for 10, 20, 30 years into the future and be confident that it will make money for you. If you're interested in learning more about this, I'll leave a video linked on screen that will give you an exact step-by-step guide of what's considered to be the best investment in the world. Number 3 is don't invest on emotion. Emotion is your worst enemy when it comes to the stock market. It will cloud your judgment and cause you to make bad investments that will ultimately lose you money. A great example of this is some of the meme stocks that have come out recently, like GameStop and AMC. These are purely fueled by hype and speculation surrounding the investment, people just following the herd and buying the stock because they see that's what everybody else is doing. Now, of course, you can ride a wave with this, but you don't know at which point you're buying. Are you buying down the bottom, at the middle, or at the top? Are you buying right at the peak, and will you be left a bag holder that will ultimately lose their money? Because of course, lots of people have made excellent returns from these meme stocks, but at the same time, lots of people have lost a lot of money from it too. You need to be investing based off factual information on research that you've done about a particular business. You have to understand the cash flows of a company, the management, what are the future potential risks that might negatively affect that business, and how much it can grow. With understanding comes confidence, and when you're confident in your investment, you will hold it for a very long period of time, 10, 20, 30 years into the future, and that's what you want to be doing. You want to hold your investment for as long as you can so it can build its value and generate more money for you. Number 4 is that you don't have to spend hours researching companies. You don't have to be the world's best stock picker, spending hours upon hours researching companies in order to invest in the stock market. When it comes to investing, the two main options that you have are stocks, individual companies, which require research, and then there are also ETFs or exchange traded funds. And these are just investment vehicles that have a particular goal. And as I said earlier, one of the best ones you can get is the S&P 500 ETF, just a collection of the top 500 biggest American companies. And with this, you don't have to have any background knowledge about the stock market or research the companies that are a part of this investment, because you know it's a sound and secure strategy because your money is in the biggest 500 American companies, and these are some of the biggest companies in the world. It gives you a great average return of 8 to 10% per year, and it's one of the most tried and true investments that you can get. No upfront time is needed from your end. You can just routinely put your money into this investment and let it grow over time, and this is what's called passive investing. Someone that doesn't want to spend all of their own time looking at the stock market, reading charts, looking at financial reports. Instead, they just want a set and forget strategy with their investment that will give them a nice consistent return over time. Number 5 is don't just invest in a company because of its dividend. The problem a lot of new investors have is that they will just try and get passive income from their investments by looking at dividend yielding companies. This is all well and good, but one of the biggest risks is falling into a dividend trap. This is when a company will pay out a large dividend, say 5% plus, to its investors even if it can't afford to do this, because the dividend is really just a payback to its investors from the company's profits, recognizing that the investors are part owners in that business because they've given their money to that particular company, and therefore it will share some of its profits in the form of a dividend. But the biggest thing to keep in mind is that this is done from a company's profits. So if the company is doing poorly and is not cash flow positive and still paying out a dividend, this will be financially hurting the business. Instead, it would be better if the company could retain some of that money and use it to grow as opposed to paying it out to its investors. And if you only invest in a company because of the dividend, you might be getting that routine payout, but the overall stock price might be falling, and this will cancel out any benefits that you get from the dividend. And overall, it might be better for you to look at a financially strong company with a lower dividend instead of automatically assuming that a company with a high dividend will be a better investment. If you want a more in-depth guide on generating passive income through dividend investing, check this video out on screen. Now that you're familiar with my top 5 investing mistakes, you might want to see how much money you can expect to make in your first year of investing. Check out this video to see my portfolio after 1 year of investing in the stock market to see how much money you could potentially make. I'll give you an exact breakdown of my portfolio, some of the things I learned along the way, and what my future plans are for investing. If I had known these things earlier, it would have saved me a ton of time and also money. So check this video out so you don't make some of the same mistakes that I did when I first started.